Muy buenos días a todos y muchas gracias por conectarse a este nuestro segundo webinar de la serie sobre Venture Capital. Antes de empezar, quiero simplemente recordarles que tenemos habilitada la función de subtítulos automáticos en español gracias a la herramienta de traducción que tiene Zoom. Entonces, para activarlos, por favor, eh, en la barra de herramientas de Zoom, en la parte de abajo principalmente está ahí, hay un icono que dice CC o dice subtítulos o closed caption. Hagan clic ahí y ahí pueden seleccionar mostrar subtítulos o en inglés show captions. Si desean traducirlos a español, pueden hacer clic en la pequeña flecha junto al icono y eligen subtítulos traducidos o translated captions. Y en el menú de idioma seleccionan español. Una vez activados, van a poder ver en la parte inferior de la pantalla la transcripción en tiempo real ya traducida en español. De todas formas, les recuerdo, el webinar va a ser grabado y lo podrán consumir también más adelante. Y lo otro que les quería decir es que tendremos la opción de hacer preguntas a través del chat y ahí eh, podemos ver nosotros las preguntas en tiempo real e incorporarlas en la conversación que tendremos con Sean. Finalmente, quiero agradecer a los aliados que han hecho posibles esta convocatoria, nuestros amigos de 10 AM Pro, la Universidad CESA, la Raín Vial, Ruta N con su programa de Medellín Venture Capital, la Universidad Pontificia Javeriana, Ruta N en Medellín, como ya mencioné, la Universidad Pontificia Bolivariana en Medellín y también nuestros amigos de Macrowise. Ok, entonces ya empezamos. So, Sean. Perdón, antes les recordaba, esto es un webinar de una serie que estamos haciendo sobre Venture Capital y el rol del Venture Capital. Tuvimos ya una primera conversación con Chris Duvos, que estuvimos más metidos en los fundamentales del activo de Venture Capital. Después tendremos esta conversación con Sean, que ya estará con nosotros, y el rol del Venture Capital en un patrimonio familiar. Y próximamente, estamos por definir la fecha, tendremos una conversación muy interesante sobre el rol del Venture Capital para un inversionista institucional, por ejemplo, un endowment de una universidad, en este caso con Joanna Rupp, que es la directora de inversiones privadas del endowment de la Universidad de Chicago. So I'm going to switch to English and I want to welcome Sean. So Sean, thank you. Thank you very much for being here with us. It's a real pleasure to have you here. And thanks for sharing this time with our people and our audience in Latin America.
Happy to be here.
So, Sean, I would like to start by learning a little bit more about you and what you have done in venture capital. So, can you walk us through your background and how you became the head of private investment at Grisham Partners? And maybe tell a little bit more about Grisham Partners to the audience.
Yeah, maybe I'll take it back just to sort of give a little bit of context how I got in the industry, which dovetails into venture, and then we can wrap up with Gresham. But I got into the industry, which I would, at the highest level, say the endowment foundation world, the asset allocating world, back in 2010. I got a start at a large foundation in Jacksonville, Florida called the DuPont Trust. I had no idea what I was getting into when I started, honestly. I didn't know what asset allocation was at the time, but I had good luck was my first boss who recommended I read David Swenson's book. And David Swenson was the CIO of Yale for many, many years. So he put this style of investing into business, so to speak. Joined DuPont and really quickly learned I loved this style of investing. But where I was able to really cut my teeth at DuPont was the venture side of the equation. I started as a rotational analyst, but a couple of years in, I had a chance to work through the private portfolio. And pretty quickly, I saw that a lot of commonality with the people in venture capital. I had some connections with people that I went to school with who were at venture shops. I just love technology. I'm a bit of a nerd myself. So it was just easy to resonate with those folks. And that's really where I was able to really make a stamp on the portfolio, get some deals in the portfolio. And then maybe 5 years into that role, was able to take over as the head of privates for DuPont. Did that for about another 4 years. Then 2019, I was in Jacksonville for 9 years of my life, and if anyone's ever been to Florida, Jacksonville is not like Miami. It is, let's say, more like the South, so to speak, in the U.S. I was ready to leave. I think in general, and as things happen too, serendipity hit. I had a couple of job opportunities. One of them was in New York. One of them was Chicago. And the Gresham one, I just saw a lot of resonation. I was just really got along with the style of investing they implemented. They love small funds. We had a lot of overlap in the venture portfolio specifically, also the buyout portfolio. That brought me to Gresham in 2019. And just for everyone's benefit, Gresham is a $10 billion multifamily office. We manage money for about 120 families. These are people who generally made the wealth themselves. So first generation wealth creators. They may have started a business. They may actually be private equity professionals themselves. I think the key common denominator across all of them is they tend to have complex estates. There's a lot of stuff we can do to help them with essentially getting their estates well in order and also just help with the general wealth management of their families. What they get on the investment side and why it was attractive to me for joining is we can build really cool endowment style portfolios. I think the one nuance is we probably up the risk a little bit. What we do is try to find firms that are earlier in life cycle, so funds one, two, or three, and generally smaller in size. So our classic venture fund is really sub $200 million. We have a couple of bigger groups we can get into later, but we like things where we think there's a little bit more return potential in general. I'll pause there, but that's sort of
Great.
how I got here.
Amazing, Chen. Thank you. So I see that you don't have a very conventional approach when you see, the
Mhm.
60/40 approach of managing portfolios, and it's not benchmark driven, but
Yeah.
looking for real value in a specific or a special firm. So how this translate to your day-to-day investment process, and what makes you different to other institutional investors?
Yeah, I mean, I think the way I'd start, I do believe that asset allocation tends to dictate investment returns in general. And if you look at the way Gresham's set up, like most shops, that we're going to have a large equity exposure. I think where we differentiate is our CIO believes that we should seek alpha where we think the most alpha exists. So if you look at our equities portfolio, while we have some real alpha drivers in there, it's going to be more of a place of beta for our portfolios. We don't do bonds. We don't do the more boring parts of asset allocation. Where our CIO wants to generate the alpha is in places that we think you can generate 500 basis points, 1,000 basis points of alpha. That really, the tip of the spear is venture capital. We think there is the most alpha to build across our portfolio in this space. And the way I look at it is if you do venture well, it's the best asset class in the world. I mean, you can generate, I want to say consistently, if consistently means over 10 years of time, I think you can consistently generate meaningful levels of alpha. And I mean, many hundreds of basis points, 500 basis points, even 1,000 basis points, as I alluded to, if you're in the top decile of performance. That's the one nuance of ventures. If you can access the top decile, I think it's a wonderful place to invest. The nuance of the space is if you're in the median, it's generally not that interesting, and that's what I think makes it fun for you and I, Philippe, because we can. I think if we do our jobs well, we can make a huge impact on the performance of, in our case, all of our family's portfolios. But it really does require one to have some finesse. And I think differentiating between good and great is what makes a huge difference. I think in other parts of our portfolio, if you're just good, generally it's doing what we want it to do. In the venture part of the portfolio, we need to be great.
I got it. Thank you. So I'm gonna step a little bit back to understand a little bit more about making that decision for a family. So why should a family consider allocating capital to venture?
I think for our families, the first foremost, like every one of our families that does venture, and I'd even step back away, but if they're going to invest in our private assets, we believe they are seeking generational wealth. I mean, they are investing not for themselves in a lot of cases, but they're investing for their kids. They're investing for their grandkids. They're investing for very long periods of time. And what I mean by that is they can take illiquidity. So that's the first question. Does the family have the ability to consume illiquidity? Will they need this money in the next decade? And if the answer is yes, maybe not the best asset class for them. However, if they have the luxury of time, and I think time to me is one of the big differentiators of wealth creation. If you can think over longer periods of time, there is a natural way for you to outperform your peers. I think venture is doing that in the purest form because we are locking capital up for a very long period of time. So we look at our families and we're very honest with them. This, in an asset class basis, we think if we put $1 of venture capital to work today, it'll probably take 11 years for us to get that dollar back. And that could be a little disconcerting at times for families. But one of the explanations we like to put is that what you're playing for is investing in companies that don't reach the public markets, that may even today choose not to go to the public markets. I mean, the best example of that right now is probably SpaceX, where the company, I mean, I should know because I've invested in it for a really long time, but it's what, 20 plus years old at this point. It's a startup, but in reality, in a different world, that company could have been public in a much earlier frame of ref time. You know, typically companies were going public 7 to 8 years in. SpaceX has created most of its value over the last 10. So it took almost a decade before it really started to hit that growth curve of value creation. I think Stripe is another company example where seemingly if one doesn't have access to venture capital, they're probably not going to enjoy one of the most important companies in this generation. And I think as we look at more and more of these founders, some of them are choosing not to go public. And I think that's where venture capital plays an important role because it gives people access into generational companies well before, and they may never even be able to get access in the public market context. So that's really what we're pushing families to do is get access to companies early that will become special. And in some cases, may never even choose to go public.
I think this is very interesting, Sean, and not necessarily you put great examples of something that we call, if you want to have exposure to the technological advancements that are really changing the world, like biotech, AI, quantum computing, robotics, photonics, etc. This is different to get into the public markets. You have to go, early on and go to venture capital. But as you put with these two great companies, SpaceX with the space economy, and Stripe, who was one of the rails for all the fintech revolution that we have seen, is the way to capture that value early on. So how you position venture capital as a way for families to participate on those technological shifts, and how you explain or get the confidence of the families to put money, even though if the liquidity is an issue, and the returns are taking longer to come.
Yeah, so the way we describe it, I think the big piece of what I think makes venture work is if you own a portfolio of it. And there needs to be a real thought to how one builds a portfolio. Because yes, the dollar we put in the ground today won't make money I won't return the money for 11 years. But if we build a portfolio that covers, in our cases, we want to be in the earliest stages. So the real inception stage of a company. But we also want to be participating in later stages as well. What we're trying to do is walk our clients through the portfolio dynamics of building a great venture portfolio to where, yes, there's risk, and we will invest in a fund who will underperform. I mean, if you're going to play in venture, I think you have to accept there's a lot of uncertainty. But in our case, we have about 18 different fund relationships in our portfolio covering different areas. We have some sector specialists. We have slightly different stages. Our belief that is that with these 18 different managers, we will have the luxury of both capturing the quote unquote beta of venture. We want to generally capture what the overall return is for the asset class. But importantly, if we pick better, we believe that we can also lean into the alpha side of that portfolio. So we get the beta and then add 1,000 basis points of potential alpha. That works. Now, the liquidity part you note is really important. That's why I go back to the overall portfolio asset allocation. I think if someone said, "Hey, Sean, we want to put 50% of our overall family's wealth in venture," we'd be like, "Whoa, folks, that is a very bad idea." The way we think of venture capital and the way we describe it to our clients is if you want to participate in the asset class, we really believe you should do it every year and you should be consistent about that asset allocation. Because we don't really know until several years past, what vintages are good or bad. Like it feels great being in AI right now. In 2025, one could make a case it's a phenomenal vintage. We honestly won't know for the next 4, 5, 6 years. And the way we describe it to our clients is the goal is to be in every vintage because none of us can pick the great ones at a time. So if someone's writing a $2 million check to us today, maybe they go to 2.2 million, next year. They'll do slight increases over time, really in linear growth with their overall portfolios. But our view is time diversification is critical and do this as a consistent part of your portfolio. There'll be bad years where, frankly, the beta is not something you want to own. But the beautiful news is a couple years later, you'll probably be in a great vintage. And if you put it all together and you have some alpha and manager selection, it ends up being a really powerful place for portfolio alpha.
Got it, Sean. Thank you. Sean, and how is this conversation go? So how does a family define what percentage of the investment, investable capital should be allocated to venture capital? How do you come to a figure with them or to a strategy?
Yes, the way we've came to it, it really, I'd say at the highest level, again, it goes back to the particular goals of their family. But if a family has their own liquidity controlled for, they own their house they want to live in, their kids are doing well, there's no immediate needs for large chunks of capital expenditures. We generally think a typical Gresham family should have somewhere between 20 to 30% of their overall asset base in private equity as an asset class. And we think of private equity, even buyouts or venture, both of which we view as, call it, a 10-year plus holding period. Now, the balance we put between those two is we recommend our clients put 60% of their private equity exposure into the buyout sleeve, where you're owning, 50+% of a business, and 40% in venture. There's no magic between 60/40. The reason we pick those two is our belief is if we do about 60/40, maybe even 65/35, they'll probably end up owning on a NAV basis about 50/50 of both venture buyout and buyouts. The nuance is buyouts have shorter holding periods. You tend to, get your money back, call it 7 to 8 years in a buyout fund, where I already alluded to venture being something akin to 11 years. We also expect higher returns in venture capital. So we believe that 60/40 ratio gets one to owning a roughly even amount of buyouts and venture. But I'd be lying to say we have hard math. A lot depends on the managers you pick. And that's the one nuance of this industry is we're making decisions today, but we're really not going to know how well they perform for the next 6 to 7 years. So it's a little bit of trying to be directionally correct, careful. We never want someone to overcommit. I'd rather someone be undercommitted than overcommitted. I think overcommitting just leads to missing vintages again. And that means if you miss a great vintage, you can really blow up a long-term return profile. But that's how we get there. We use the Yale model, which is you can find it on the Google. I would say it's fine. It's essentially a liquidity model that helps take the commitments you have on the ground today, expected distribution periods, expected capital calls, expected return growth, and gives you a very loose directional sense of what your illiquidity or what your percentage of an asset class could be. But I say directional because it's plus or minus, you could be 3 to 5% off very easily. So it's definitely more subjective than objective, so to speak.
So let me understand something, Sean. So in Gresham, you only do private investments?
I cover our private portfolio. So we have
You
another
cover,
team so another team of ours looks just like us, similar number of people. They would be investing in a portfolio of both long only equities and hedge fund strategies. So
okay,
typical families will have most, if not all of their wealth under the banner of Gresham, but they're going to probably
okay.
have, call it 75% in quote unquote liquid strategies, maybe more like, probably 65 to 70%. And the other
Mhm.
25 to 30% would reside with me in the illiquid strategies. And
And
then
this will be the 60/40 that you were explaining before.
exactly. Yeah. So, and the goal is we really want families to view the illiquid part of their portfolio as the alpha driver, but we want them to never be losing sleep at night. And that's where if one of the advisors comes to me and says, "Hey, Sean, the clients, they're debating between, let's say it's 3 million and 2.5." I almost always pick the lower number because to me, I'd rather them come in, like, if they end up deciding, hey, it was a little bit too low, I'd rather them come back to us a year or two later and say, hey, we'd like to do more the next time than get themselves overweighted today. I think it's really easy to get over your skis in whether venture buyouts, the illiquid world. I think it's easier to start with a long-term goal. And then if you're a little underweight over time, you can scale in rather than trying to scale out. Again, I think missing a vintage is the single worst thing a family could do because I mean we've seen it in the stock market. If you miss a couple of days a year, you lose like the vast majority of the return. I think privates aren't that dissimilar to where there are certain years where there's just much better returns to be had, and we want our clients to be consistently investing throughout all of them.
And Sean, I want to dig deeper into missing a good vintage. And I think that relates to missing a great technological wave.
Yeah,
It's like
absolutely.
the biggest risk that you can have right now in what's happening in the world is not being in what's happening in the
Oh,
technological advances of what we see in venture.
yeah, I mean, we can take it back. I think the easiest period of time to look at is look the tech bubble, the mania of call it the mid '90s through 2001. People generate amazing returns, right? The multiples of funds in those sort of '90s years were incredible, right? Sequoia's pumping out like 25x net funds consistently. It was this great time. We all know what happened. The next few years were really tough, right? So 2001 to 2005, it felt like venture was dead. So a lot of LPs got tired and said, you know what? The tech bubble was a bubble. It's never coming back. They left the asset class. What I think they didn't realize is despite not a lot seemingly happening between 2002, 3, 4, 5, 6, 7, 8, there were still amazing companies being formed. We just didn't see the returns generate for years after. So what you came to find out was the 2000s were actually a really interesting time to invest in venture if you were in the singular right companies like Twitter. You can go through it. There were some great companies found in the worst years. It's okay if you weren't in 2002, 2003. There weren't great vintages. The nuance is we actually moved into a period of phenomenal vintages in the 10, 11, 12, 13. I mean, the teens were just a phenomenal period for venture capital because people would have seemingly burned in the early 2000s. They gave the asset class up. And you see a lot of people playing catch up in the 20s as they realize, oh my gosh, I missed a decade of venture capital. And it's really because, like, yes, there were a few bad years, but if you over index to the bad years, you're going to miss a wave of great years. I think you could say that across a lot of asset classes, but I think in venture, you get some highs and lows, whether it's a mania or despair. And our view with clients is look, there's ups and downs. We're going to try to help people moderate. I think we can, I think thoughtful management, like if you and I do our jobs while picking managers, I think you can help bring the highs a little bit higher where you have more alpha potential. You can hopefully pick people who avoid some of the hype cycles as well. But we should expect there to be periods of greatness and periods of weakness. We just want to make sure people are in all of them. That way they enjoy the best parts too. I think there's natural human, it's human nature to move out when it's scary, and that tends to be the best time to invest. We try to get our clients comfortable with this. Just trust us, being consistently, and this will be an amazing asset class. We really hold them to that, though. If someone's looking to come in and out, we generally recommend they choose not to.
Great. I think I think that there is a great feature of investing in venture capital is that it's like a vaccine against your humanity because there is no way you cannot do anything. You have to wait until the funds go on and returns start coming, and it's an illiquid asset. So the instinct of doing something that seems rational but is more related with emotion is not there, and force you to look at the long run and wait for the technologies to develop, to mature, and to capture the value.
Exactly. I mean, that's what I think. It's the funniest thing is sometimes the best companies take 6 to 7 years to even inflect. I mean, we're in a little bit of a weird period because some of the AI companies are showing really early like ARR, quick revenue. But the truth is, we're not even sure if that revenue is sticky. But you have the other case where 6 to 7 years, not a lot, but eventually someone clicks, finds product market fit, and it's off to the races and a great company is formed. That's the part that we find most exciting about this asset class is that you just have to be patient, trust the managers you're investing in. And if you pick good places to be, you generate really meaningful levels of alpha.
Got it. Thank you, Sean. Sean, let me go into another direction. And is we understand the capacity of this asset class to produce alpha and to have a very interesting risk return profile. But it also plays a function in a portfolio and is related with the correlation with other assets. How do you see the role of the asset class when you see a portfolio in the macro way?
Yeah, and to me, the easiest way, this is you're basically getting equity beta supercharged. I think that's the way I view venture capital. I mean, Frank, I do buyouts the same way too, although it's going to have much more of a leverage component to it. But I think if someone's investing with venture capital, they should, and they're trying, let's say someone, their goal was to be 60-40 equities and bonds, like the simple math. If they were to add venture capital at 5% and they still want to be roughly 60-40, so to speak, I would take that 5% out of the equity, out of stocks And that's the beta I would use for it. To me, it trends closely to stocks. I mean, not surprisingly, it would have trended similarly to Mag 7 over the last, decade. So to me, we think of it very much as coming out of their classic equity exposure. And the goal is to generate equities plus, 500 basis points or more is the way we're trying to index that to.
I got it. The other question I have here relating the relationship with the other asset class is that we see traditional assets classes experiencing significant price appreciation. There is like asset inflation. How can venture capital serve both as a diversification tool, but also a hedge against this asset inflation?
Yeah. I think, I mean, absolutely. I mean, we're seeing that now. I think the way there's not surprisingly, as interest rates go down, the cost of capital gets lessened, and people generally plow it into assets. Startups are no different. I think if you look over time, I think you can look at like seed valuations. Um, Venture capital valuations have just gone up over time. And I think that is to your very point. We're just seeing another version of asset inflation. It's been true in the stock markets. I mean, it's true in people's homes. I think it's equally true in startups. As inflation has grown across the world and seemingly continues to grow as ours in the US president seems to be pushing for the Fed to be less concerned about inflation in general. um, our general belief is the way people value these businesses just goes up over time. So it probably does track inflation. It's probably a decent way to look at it. The way we're thinking about it is startup valuations are certainly higher today. What we're waiting to see is, are the exit markets going to value them the same way? And does that mean, and really what I mean, do public markets value these companies in a similar form? And I think Figma was a singular good example to where Figma was valued at a level that I think speaks to your point. There's clearly been venture as inflation, which I think was received well by the public markets. I think the way Facebook has acquired scale and various different acquisitions recently would agree with that. I'd love to see a couple more examples. I think Klarna is going to go. I saw that this
Mhm.
morning. They're like the next big one. I think I'll be really curious to see that company's valuation. But if we have a few more good examples of public markets accepting higher venture valuations, then I'd agree. Then one, there's inflation in venture, but more importantly, the public markets are accepting it as real. That's the piece. I want to get our money back. That's maybe the one. There's a reason I'm harping on the exit is it doesn't matter to me till it's returned to me in a form of cash. So I want to see that
I got it.
inflation get come
Absolutely.
back to me in cash.
So what I understand is this synchronization between how the public markets value whatever is coming out of venture capital is key for really getting the money back for whatever you were investing in venture capital and the type of inflation you experienced during venture capital.
Exactly. To me, like I agree with the way I think there is inflation in venture. I want to be paid for it on the exit, and then we're actually making a return off of it. What if venture overvalues something and the public markets say, "Oh no, it's worth much less," then that inflation meant nothing to me other than higher prices. Um, the good news is I think there is some sign of the public markets receiving these companies at the levels we want.
I got it. I got it. Thank you, Shan. So, Shan, when a family comes to you and they're coming and understanding the role of the asset class in their portfolio, I will put it in simple words. Families come and they want you know, to to keep the value of their wealth, to preserve their wealth or to grow and build on that wealth. How venture capital play a role in that two different objectives?
Yeah, absolutely. I can say every family is looking to first preserve their wealth. I mean, no one comes to Gresham without the goal of generational wealth creation. But of course, even families that have philanthropic goals still are looking to grow that wealth. So the way we like describe it to our families is we are going to have parts of our portfolio that are on the preservation side. For instance, I invest in real estate, I invest in oil and gas, things that very much are on a different cyclical trends. We describe venture as the way they can really grow their wealth over time. And so that's why it is really the tip of the spear for our families in their wealth creation over generations. Like we really want our venture portfolio to be if public markets are doing whatever 12% over very long periods of time, we're looking for our venture portfolio to be deeply into the 20. I mean, we want to do 20% net returns in the venture book or higher. We are trying to generate serious levels of alpha. And the reason we need that, actually, I think you nailed the point importantly. We also have other parts of our portfolio that will underperform publics deliberately. So we have hedge fund portfolios that deliberately have much lower beta, that preserve capital very intentionally during periods of difficulty. And we need the venture to offset those return profiles. That way, over 10, 12, 15 years, we are generating the right levels of alpha where we are generating material levels of wealth creation. So think of venture as almost the offset, where this is going to be the foot on the pedal of the car, so to speak, where we have other parts of our portfolio that are preservation oriented. This would be the creation of wealth, really the alpha again. This is the alpha part of everyone's portfolio question.
I got it. So my last question here is regarding who this asset class is not a fit to. Have you experienced, the conversation with a family and you say, look, this is not the right asset class for you?
Yeah, I think it's a really good question. And, I may meet 30% of our families probably want to sit down with me and chat. And I think what I've noticed when someone is extremely uncomfortable with illiquidity, we generally recommend that this is not the asset class for them. And this it goes back to that point I made earlier is the real alpha in venture is time. You're giving some really young, talented engineer, um, capital, and the goal is for them to build, to our point, generational technologies, things that'll change our lives. Those are the ones that really are the most meaningful on a return basis too. They both change human lives, but they also generate lots of wealth. Those usually take long periods of time to build. So someone needs to be comfortable investing their money. And I go back to that SpaceX example to where, I had the luxury of being in the founders fund portfolio that has that position in it. And I mean, 18 years in, you still have a massive amount of money sitting in founders fund, fund two. But by the way, like most of that wealth creation, I mean, between years 11 and 18, you saw it go up from like a three times, I'm making numbers up, but like, well north of a 20 times. So you had this fabulous amount of wealth creation backloaded in that case. And you need a client, at least in our case, a client that's comfortable with the potentiality of having their money invested, and maybe they don't get it back for 20 years. But the good news is if it takes 20 years, it's probably the good case scenario to where you're invested in that special company who chooses not to go public and everyone around it knows it's special. So I go back to illiquidity. If someone really doesn't want illiquidity, not the right asset class. But if someone wants to be a part of technological innovation and they have the luxury of time and the ability to take on illiquidity, then I think it's a wonderful place to generate meaningful levels of alpha.
Got it. Thank you, Shan. Shan, I'm gonna switch gears now and become a little bit more practical. So for a family, a Latin American family, or a high net worth individual who is convinced on the value proposition of venture capital, what are the options they have to get access to the asset class?
Yeah, so this is it. It's like I've given all the fun parts of venture. Look, venture is really hard. And I go back to that initial point I made, where the top 10% of venture is a wonderful place to live. The other 90% is not that good. And I think everyone needs to come in eyes wide open around that fact where, like, here's a little silly point, but I live in Chicago, and there are a lot of VCs in Chicago who knock on my door all the time. And I can tell you, it is really hard to invest in a local Chicago shop because the truth is there hasn't really been a great company that's came out of Chicago. Like our big one was Groupon. If you even remember, that company did not work. Groupon eventually failed. And when you don't have a massive winner that's creating a lot of really smart engineers who are starting companies, I have to question, so what advantage, if someone's sitting in Chicago, what is their advantage of finding the next 100, $10 billion company? It's not their local distance, right? I mean, they're going to basically be calling people that live in San Francisco or other parts of the country. So long story short, we don't do Chicago VCs because there's no location advantage. Um, and where I'm going with this is you have to be really particular as an investor in venture capital around what is someone's differentiation. Like, why is this person going to have an edge to find that next great company? Um, so I think that's the rub of this asset class is it's great when it's done really well. But if you can't get access to the very best firms, and by the way, biggest doesn't mean best. And I think that's the one nuance that people conflate large and size with ability to generate returns. Like, that's another mistake. You really want people who are uniquely placed to be around really amazing founders, and they have the right amount of capital to where they can get the right percentage of their fund into that company and build a well-diversified portfolio still. Um, you have to have access to that. So it takes a pretty special blend of as in our case limited partners of accessing the very best venture capitalists, then convincing them to take our money, because by the way, the very best don't usually need your money. So it's a little bit of charming them, it's finding them, diligencing them, and charming them. And I think from Latin America, it's certainly, I don't think you could do it from anywhere in the world. It's just you need to be in San Francisco on a regular basis. You need to be in New York. You need to be in LA. You need to spend time with these people. You can't just pick up the phone and call them and say, "Hey, I'd like to invest $3 million." They're not going to take that phone call in the first place. So I think finding a way to access the market first, and then secondly, learning how to pick is hard. So I think having like solving those two things are really important. If I were a Latin American family, I'd want to have someone who can help me do that. Or at least I'd ask very clearly, what is the reason I can do this well?
Sean, let me go back and be precise on one specific thing. Let's suppose that a family office here in Latin America or wherever want to start doing the investment directly. What will you recommend them to build as internal capabilities for doing themselves?
Yeah, and do you just to be direct as in a fund investment, or do you mean actually directly into the companies?
No, investing into funds. I think into
Yeah,
companies is even more complicated, right?
that's why I want to differentiate. I think to do this well, I think you need to be willing to do this on a somewhat full-time basis. I mean, I think it's hard to be a tourist investor in venture capital, and it's because the markets are changing so quickly. Just AI didn't even exist 3 to 5 years ago, right? It's like that just came out of seemingly nowhere. I remember we all had our Chat GPT moment when we first started using it when they released it. I think it was whatever a couple Decembers ago, and the game has changed dramatically since then. You need to be willing to be on the ground around these venture capitalists on a regular basis. I think it requires a dedicated team, personally. I don't think you have to have a head of venture capital per se, but you need to have someone who's willing to spend 30, 40% of their time understanding the venture markets, understanding who has access to great companies, what does great access even mean, building a network. I think you need to have a resource like you or I, willing to spend a meaningful part of their day doing this well. Like I'll be in San Francisco all of next week, meeting with a bunch of different people. I do that trip 3 or 4 times a year. When I mean long trips, I'm in San Francisco, I think it's at least 6 to 7 times a year. And I'll do three of those will probably be a full week. And it's just you guys got to run into people, and I'm doing a meeting with a Thiel fellow and a dinner with her, and it takes time. It just takes a lot of time.
And Sean, and the reason for it for this activity to take that much of time, I think is because this is a business of people. It's like when an entrepreneur choose, they're really good entrepreneurs, great founders. They choose their investors and not necessarily the shop. It's like the real partner because this guy knows how to run this type of companies or build a company from 0 to 1 in this specific field. Is the expert on that specific technology or market, etc. And then it's people, and then you also invest in managers. You don't invest in logos. You invest in the people. And in order to do that, you need to know them, but you also need to know people who know them in order to do the
Yeah.
reference calls. I can never understate the importance of understanding that this is a people driven activity, and this takes a lot of time, and you need to build the network and the resources not just to access those great funds or managers, but also to be able to underwrite them because it's private. The information is not as easy to evaluate when you are talking to a public investor. Can you elaborate a little bit more on the importance of doing this?
Yeah, I mean, I think it's almost even understating it. I mean, the way we think about it is we need to be in people. The first for one, like, does the person that we're talking to see a lot of deals? And what we mean by that is, are they in a network where their friends are starting amazing companies? And the fish in the barrel is the thesis, like sort of the joke we like to use. But we want someone who, if they just literally throw a dart with people in their network, they're going to run into great companies. So first, like, are they seeing great companies? That's the first thing we spend a ton of time. So are they around great founders? The second piece of the equation for us, and you were hitting on this, just because you see a great company doesn't mean you have the right to invest in it. And I think that goes back to your point of referencing. Then you have to check, what is this person's value in the ecosystem, such that if they find a great founder, that founder is going to take their money. And the joke we always like to use is, if Sequoia walks up and tries to steal the deal, how would this person keep it? Because look, I mean, Sequoia is really good at what they do. So we want to find someone who both finds a great deal and then they have some kind of value add, something that allows them to keep the good deal. The final piece of the equation is judgment. And then the question is just, are they actually good at investing? And you put these three things together, and it's really, I think it's hard to do one. To your point, I think understanding what a founder wants is pretty unique, because a founder, in enterprise SaaS, the founders tended to be multiple time. They tend to be in their 30s and 40s. They've done a couple tours of duties. They probably started a company before. They would resonate with a certain kind of venture capitalist. Well, let's look at the AI companies today. It tends to be a PhD researcher. It tends to be a 20-year-old. That person probably resonates a little differently with the founder, with the VCs they're working with. So we're trying to put ourselves in the headspace of the founder and saying, hey, who does this person want to work with? And then to your point, calling all the references around the VC to make sure that they have some kind of gravitas to be in the right spaces. There's a lot of it's a lot of subjectivity, but when you do it well, I think you can build a really nice schematic, a mosaic of why a particular person or a particular firm is in a position to win. Um, but the shelf life of that position to win is also pretty short. I think that's the piece that limited partners can miss a lot of times. Is I think different firms are great at different moments. And let's say like the PayPal mafia. I think Peter Thiel's a unique example, but that's been used as there's like a great way to invest for years and years. But that the mafia over time becomes less valuable. Then I think there was a Palantir mafia, and then there'll be an Enduro mafia and a Stripe mafia. What we always sort of spend time on is, what's the shelf life of that experience, and what's the value down the road. So we're trying to take, what is that person's value today? How much value will they have 3 years from now? It's a lot of underwriting and looking around corners to understand how long does that value even persist.
I got it, Sean. Very interesting. So there is capabilities that are very special that are needed for doing this job. I have people asking here a question about the amount of money that should be invested here. And I think that there are two approaches there that I want to touch with you. One that we already covered, that is, what percentage of your portfolio or your net worth should be allocated to this asset class. This is one way to come. But the other way is understanding diversification. And is what is the minimum amount of money, if we can come with a number, but more the concept is that you need to diversify in order to come to this asset class. And
Mhm.
this needs money. It's something that you cannot do with $1 million. Can you
No.
elaborate a little bit more about the importance of diversification? In which different vectors should you already talk
Yep.
about vintages, but also type of managers, sectors, etc. Can you explain about diversification and the relationship with the amount of money that you should dedicate in order to have a well-diversified portfolio?
Yeah, so I'll take these first. Let's just talk diversification, and then we can put some concepts of money around it. Um, we have about 18 venture capital managers. I think one could do it with a few less. So let's just be fair. I think if somebody was looking to build a world-class venture portfolio, it'd be tough to do without at least 8 managers. I think in reality, I'd like to have more, by the way. 8 would be at the very low end. The problem is, if you have one single bet in venture, um, you have too much weight on one single firm. Unfortunately, like I said, if you look over time, firms go up and down, people's skill sets go in and out. To your point, sectors go in and out. To me, you really want to have diversification across enough firms. The way I think about it is quite simple, is I want enough firms to where if one of them were to go away for whatever reason, one of the GPs gets hit by a bus, like the hit by the bus risk is the easy one to use, that I'm not scrambling to replace them to where, and that's where I say if you have eight VCs and for whatever reason one of them were to go away and you move to seven, you're not scrambling to refill it. I think at eight or so, you'd have enough flexibility to have some sector specialists. I think in this day and age, the way we build our portfolio is bifurcated. Where on one end, we have two multi-stage firms. We have two of the better multi-stage firms. The other side for us is all early stage. And if you were to actually dissect that early stage portfolio down a layer deeper, we think about it both by stage, so pre-seed and seed, and we also think of by sector. And so we have, for example, consumer is a really good example because if people think about consumer, consumer startups were essentially the first 15 to 20 year, like say 2000 through 2015 was all about consumer startups. You think of Facebook and all the various different applications, Instagram, et cetera, et cetera. Between 2015 and 2020 now, basically, there's been no real new great consumer company. In China, we had ByteDance, and I recognize it's a massive company, but
Mhm.
I don't know if people in the US don't really get a credit. But ByteDance aside, there hasn't been a great consumer startup. Well, we looked at our portfolio, and a bunch of our multi-stages weren't really doing consumer anymore. Our sector specialists, we didn't have a consumer specialist, so clearly they weren't. We had nothing. Basically, we boiled down to we don't have consumer exposure. And we looked at artificial intelligence and said, okay, we are in a technological shift. Not going to wager how big of a shift it is, but it feels important. Our suspicion is there will be some kind of consumer app that feels different over the next decade. And I'm not smart enough to know what that means, but there'll be a next Instagram or a next whatever, a next social something, a next consumer company. We said to ourselves, hey, if our multi-stage firms aren't doing a lot of it, we have no specialists. What should we go do? We should go find a specialist. So we went and found a young woman who is focused on consumer AI because we want to have a focus. We wanted some consumer exposure in our portfolio. Then that's a good example to your point. We identified a sector we were underweight and deliberately went to go add more. We've also added infrastructure. We've added crypto. So I think if you want to get a diversified sort of overall exposure to venture as an asset class, you can look at the pieces you have. And in our case, we had to add a couple. And I think we had to add crypto and we had to add consumer because we were underweight those and we wanted to have some exposure. So I think you need at least eight. In our case, look, we have 15, we're closer to 18 managers today. And I think some of we've had to scale up a little beyond that minimum because our check size is big enough to where we almost have to. But I think anyone, if you only have three or four managers, you're liable to miss a great startup. The other nuance I'd point out here is if you're in venture, you want to be in the big wins, um, and you want to have coverage across a number of companies. Like if you're in venture and you don't have open AI exposure, that's a problem. You want to have exposure to the big companies, and you probably need to have enough VCs to capture that exposure too. So at a high level, 8 to 10 managers probably bare minimum to have diversification. On a dollar weighted basis, to get access to the best funds, um, if you're not writing, it's tough to do it if you're not writing $3 to $5 million per firm. And by the way, that might not even be enough in some cases, but I think at 3 to 5 million per fund, you're meaningful to that fund. Below that, it can be tough to get a meeting. Um, because at $1 to $2 million, you're sort of a friend or a family. And if you're neither friend nor family, they may not want to work with you. So there's a little bit of a scale disadvantage until you cross that threshold of being, call it $3 to $5 million to where the VC says, oh, this is a meaningful check. I want to take this phone call. So if you're under that, it's just going to be hard where I think you might just unfortunately get negative selection bias. If you want to write $100,000 checks to a fund outside of being friendly with the GP, they're probably not going to take that phone call. And so the negative selection bias would be quite difficult to overcome.
I got it. So just to summarize, it's not just the number of funds that you need to have this diversification in
Mm.
the different dimension that you that you expose, but it's also that you need a certain minimum of ticket in order to be able to get access to the right ones, because maybe you can have adverse selection. But then you have to do it in different vintages. So it's not that
Yeah,
you only have that, you
no,
need that every 3 years or every 4 years, or
exactly.
whatever is the cadence that you're doing the venture capital investments.
Exactly. I mean, you put all these pieces together and you create a pretty steep bare minimum number of funds to where, you're just, I think you want to have all of those. You want stage diversification, time diversification, sector diversification. Again, you're trying to buy beta, the asset class beta, and then adding alpha on top. And if you miss large chunks of it, you're going to miss the beta. And I think that's, if you look at the endowments today, I was just at a large grouping of LPs, all private equity focused, so lots of venture capital talk. And the big talk of the group, the conference, about 50 of us, was if you were underexposed to OpenAI and Anthropic, what that basically the view was you're missing beta. So those companies were viewed as the beta of the asset class right now. And if you were underexposed, what do you do? That was the big question. The question du jour was, what do you do if you're underexposed to those two companies? And there was no right answer, right? As some people were doing the SPVs, but it goes back to that point. You want to have enough VCs. Like in our case, we have plenty of exposure to OpenAI, so we feel really well positioned. But it goes back to the point, you need enough VCs so you have somebody who hits that company, and then deep tech and crypto, et cetera, et cetera.
I got it. Very, very interesting. So I want to go deeper into one specific dimension that you mentioned, that is emerging manager and established managers. But I also want to differentiate established managers in two different categories, because we are exposed to these, big flashy names that have grown
Yeah.
crazy and are managed multi-billion dollars funds. And of course, when they are raising money, they need to go everywhere in the world. So I
Yeah.
would like to understand what is your approach or your view on emerging and established, and between established, the ones that have continued to be disciplined and continue to do what I call pure venture capital, and those who has evolved to a different type of asset, I will say, because what they're raising is huge quantities of money. Can you tell us a little bit more of what you're seeing, how a family should approach this type of funds, and how do you diversify into emerging managers and established funds?
Yeah, no, I think it's the right question today. I mean, look, the simplest thing I start with is we always ask this question, why are we so lucky? And I think whenever someone comes to us and needs our money, that's the first question I always ask myself. And I think the groups who are raising massive quantums of capital and going wide and far to raise it, uh, they're probably solving a different return equation. I think that's my general view. And I don't want to go through the names that we've declined in our portfolio, but we were an investor, a long-term investor with one of the bigger, flashier names. And they did a wonderful job for us in the teams. I think they weren't the best VC in our portfolio, but they did a fantastic job. We'd all love to have that return profile. And in our opinion, in the early 20s, they were seeking a different return profile, and frankly, a lower return profile, to where I think they were targeting something more in the two times your money rather than the three times. Like, our goal is to step back. We want our venture portfolio to do something close to a 3x return, which is not easy to do, by the way. 3x is hard to do
Mhm.
across a portfolio of managers. And in our opinion, if our big multi-stage firm is targeting something closer to 2x and our goal is a 3x, eh, it doesn't really feel like we're solving for the return profile alluded to earlier, right? Again, I want this to be our CIO wants us to be the alpha driver for our clients' wealth. A 2x for our clients isn't the alpha driver. We could do that in other parts of the portfolio. So in our opinion, we want to be focused with managers who are still seeking what I say, sounds simple, but venture like returns. To me, that's 3x net or higher is the targeted return profile. And the ways you do that with large quantums of money. So if someone's raising, let's say I'm making numbers up, but a $5 billion fund, one could still target venture returns with that portfolio. What I would look for is concentration. Because to me, if you're going to deploy $5 billion effectively, you probably have $1 billion in a single company. Like, you have to have a few big bets to make that math work. And like that, maybe today, maybe it's OpenAI. There's a lot of companies who can consume large amounts of capital. But if I'm investing in one of the bigger firms, I want to believe they have the ability to concentrate capital really, really well. And we look for that in anyone investing in the later stages. It's less about, we don't want someone to build a portfolio of 20 assets. We'd rather them have 10 assets and three or four of them represent the majority of capital. Because that's still, you can find a company that's at $10 billion valuation today that goes to 100. But I don't think you're going to find 20 of those. I think you might find a few of
Mhm.
those. So that's our view of the bigger, more established firms. Um, what we really think of the alpha driver, though, is those emerging managers you alluded to, because in our opinion, it's just easier to turn a small fund into a bigger number because you're just coming in at a smaller valuation. And I've alluded to it earlier, but our goal for our emerging managers is to be pre-seed or seed. And what I mean by that is just the first or second check into a company. And our presumption is by being in the first or second check that the valuations are still pretty low. And we have the ability to get into a company at $8 million dollars or maybe $20 million. And if that ends up being a special company, it's worth 1 billion, 2 billion, 5 billion, that single investment might return the whole fund for us. And I've had the fortunate luxury of being in a number of examples like that, where you can have a company return the whole fund over three, four, five times. And that's where you generate serious levels of alpha. So we build our portfolio for the exceptions, where we're looking for funds that can generate a 5x net to us, a 10x net to us. We've had the luxury of being in, I think, three funds that were 25 times their capital back to us,
Wow.
cash back. And look, that's not easy to do, but you tend to do that with someone who's at a smaller fund size. And they tend to be at smaller fund sizes early in the life cycle. If they're special investors, uh, they tend to, they do really well. Unfortunately, growth and doing well tend to correlate in this industry, where if someone's great, they attract more money, they get bigger, returns tend to moderate over time. So it's our view, we want to be in the first few where the fund sizes are really attractive. And then honestly, we tend to downsize our tickets with people over time. So as they're getting bigger, our commitments tend to get smaller. And so we're going the
I
opposite
got it,
direction.
Sean. And I want to build on what you say. It's not easy to do, but it's
No.
not as simple as just saying that. And it's not easy because in emerging managers, there is a proliferation of emerging managers right now. It's
Okay.
crazy. And and the dispersion of returns is crazy. It's like, being an emerging manager and giving 25 times the money of the investor is that you are in the top 1%.
Oh, it
It's
is
very difficult to go to get to these guys, and you should need some luck as well. So it's also for people to understand, when you move to the established firm, there are fewer of them and they have a more modest return.
100%.
Some of them are great, of course. But on the other side, when you say, okay, then I want to go to emerging manager because the alpha is there, but it's
It's
very difficult because the proliferation of emerging manager is huge, right?
100%. And I think the hardest part is when you're backing an emerging manager, you almost have to break out of your own view of the world. Because again, what makes someone a great investor as an emerging manager, it's typically eccentricities, right? It's going to be the quirkiness of their personalities. Like if you were to back someone who he comes like right out of Goldman Sachs and has the amazing, they went to all the right schools, worked at the right banks, and they give you this really great pitch on being a great VC, they're going to do a terrible job. Like they're the last person you should invest with. You're looking for the quirky person who worked at this interesting company, has a personality that resonates really well with founders, and then again, like happens to play poker with them on the weekdays or something. Like you're looking for the quirkiness of what makes them special. And so it almost forces you to move outside yourself. So yeah, I mean, I'm making it sound easy when I talk about 25x funds. I mean, most emerging managers are awful. I mean, they're terrible investments. And I don't think, I mean, when I say, 90% of ventures not good, I think when you look at emerging managers, it's even a worse number. Like 95% are probably bad, right? It's most of them are uninvestable. By the way, most of them won't even raise a fund. And if they raise the first fund, they'll probably not raise the second fund. So it's a really hard business. And I think in our world, we're trying to do one or two new ones a year. And we see so many. I mean, I can't tell you how many emails we get. I mean, our filter for just taking a call is actually pretty hard. I mean, most groups we don't even take the phone call with because you can just read the backgrounds, like, this person has nothing. There's no right for them to win a deal. And then most calls, their portfolio construction's bad. The check sizes they write don't make sense. We look at their judgment, and I think one that we see a lot is they're swinging for singles and doubles. small company ideas. When look, if you're in venture, we want people swinging for triples and home runs, right? Because the game is to find $1 billion company, not to find $100 million company. So you need someone who takes risk and leans into it. There's all these various factors that when you find it, it's really special. But again, like 99.9% of times, it doesn't work. So yeah, I think there's a real expertise. I hate to use pattern recognition. It can be a little bit of a dirty word, but you sort of have. I think you can figure out what bad looks like, and then you say open-minded around what good could be. Is how we think about it. So we learn what bad is, and then we say open-minded around what could be good. Takes reps though, lots
Sean,
and lots of reps.
I will I would love to continue digging deeper into this, but just to give the audience a sense, is there are so many details in choosing a manager and constructing a portfolio. It's not just that, is the manager leading the rounds in pre-seed or just following and being in cooperation with others. There are different skill sets for that. They are doing a concentrated portfolio or much more diversified portfolio. Do they have a follow-on strategy or not? But we can talk for hours and hours. But I
Okay.
want the audience to get a grasp of the complexity of this asset class and how to choose the right managers that are playing the specific role that you need when you are constructing a portfolio.
Here,
So
I'll
I
give you,
want to switch here. Go ahead.
no, well, it's fine. We can switch here. But I give an example. If someone's raising 25 million or 50, they could be great at 25 and terrible at 50. And I think there's so much differentiation. It sounds like a small difference, but in reality, it's everything, which just speaks to that complexity as you were alluding to.
Absolutely. So I want to switch gears and come back to the original question that led us to this conversation, and is, okay, if I don't have enough money to build this portfolio that we're talking about, in the number of funds, the type of funds, all this nonsense that we were discussing, uh, what should I do? But before answering that, what are the mistakes you have seen families do in order when they're trying to enter into the asset class? So for our audience to avoid those things, and then we can say, okay, what should I do? How can I access the asset class if I don't have the capacity to build this diversified portfolio?
I think the mistake we see, it's the right question. Assuming you don't already have a brand in the asset class, so you haven't been doing venture, if someone reaches out to you trying to sell their venture capital fund, the odds of that being a good investment are just exceptionally low. Exactly that point we made earlier, the really good firms don't just randomly reach out to family offices. They may, if someone said, hey, this is a really good firm, you should talk to them, like they may get referenced into you. But if they just randomly cold reach out, it's usually a bad sign. I think the worst mistake a family can do is meet someone when they haven't done venture capital before that came to them cold and then convince themselves this person has an edge and then start their journey into venture capital with probably what'll work out to be a really bad first step. My view of it is one should first learn to crawl before they walk and then walk before they run. So to me, one needs to build up a view of what does good venture look like, and really have some help building that view. Like you almost have to see it to know what good is. And so I always recommend people to start with have someone to help them out, like tell them what good looks like. And then you could start to figure out what bad looks like. But don't, the most important thing is do not just make a venture commitment and expect it to work without having some assistance along the way. 'Cause I see people, families come to us all the time with that local, again, we're Chicago based. They'll have a Midwest based venture capital fund in their portfolio and ask us, is this a good start to venture? I'm like, okay, we'll be very polite. Like, it's probably won't be what you want, but hopefully it returns your money. We see a lot of really bad venture in our families. And our first coaching is, hey, please don't do venture capital investments on your own. Let us help you with that part of the portfolio. And we sort of push them to spend their time elsewhere. Venture is the hardest thing to do well. So find an expert is the thing. Don't do it yourself, find an expert. And then maybe build into it over time is maybe my advice is learn what good looks like and then do it slowly yourself.
Sean, one comment, and is even in Latin America, this could be more critical because, as you were saying, great funds are not knocking the doors of family offices in
No.
the United States. It's even worse here in Latin America. If there is a U.S. fund coming here, knocking your door, asking for money, the probability of having an adverse selection there and a bad experience is really high. Let me ask you just one question about the the fund of funds model that is what we do, and in some cases the philosophy of the investment approach is similar to yours, even though the model is different because you are a multifamily office. But how do you wait, or how you ask the families to wait the additional layers of fees, even though if
Hmm.
it's a management fee or whatever is they
Yep.
are paying to you, against the benefit of bringing somebody who is an expert for doing venture capital investments?
Yeah, I mean, like I think that's the rub of fund to funds, a rub of anything that's an extra layer is the fees, right? It's obvious. Like that's the part that people struggle with. I think the fortunate part of venture as an asset class, and the reason, if you look at all fund of funds as an industry, the one asset class where fund of funds have persisted over time has generally been venture capital. And the reasoning for that is if you are in that top 10%, that top 5% of venture, the amount of alpha you generate over median is such that you can overclass any layer of with any reasonable layer of extra fees. And I've had the luxury of seeing some of the better fund of funds over time and seeing their performance, and they've put up very good returns net to their LPs, despite having that extra layer of fees. So I think this is the beauty of the venture asset class is there is such a layer of alpha to where if you can pick someone who brings you up here and gets into that top decile, you're going to remove that extra layer a million times over. I mean, look, bad venture, and you're not getting $1 back, right? I mean, you're hoping to get 60 cents back. You're hoping to get 80 cents back. Even top quartile venture is like a 1.8, a 2. It's not a great asset class to where if you have a partner who can help get you in the top decile and put that 3x net, even if they're taking a little bit of a cut, it's still going to be a whole lot of alpha relative to a median portfolio and a top quartile portfolio. So that's the way I'd put it, is there's enough alpha in this asset class to overweight that extra layer of fees. And I've seen it, I mean, it's been true for 20 plus years. So in my belief, even though the asset class has institutionalized, in a way, I think the fact there are these really big firms may even allow people to stand out more. Because to your point, the emerging managers might be where that extra layer of alpha is, and it's even harder.
Yes, I got it. Doing bad venture, as you call it, costs much more than the double layer fee of doing good venture.
Yeah, Nasdaq's better than bad venture. That's not going to do Nasdaq.
That's true. So, Shan, now I'm gonna move to how do you see the asset class right now? What is the current environment compared to what happened in the past, and how do you see structural changes coming into play in this industry right now? What is your sense of the venture capital asset class right now?
I think it's the combination of, we're in a pretty amazing technological shift. And I don't think we know how fast AI is going to change our lives in a material way. I mean, we all have had fun with it. How long till it's actually adding extreme levels of value to our economies, efficiencies, et cetera. A little bit TBD. That has created a lot of hype, and I think we're in a period of a massive potential, and we're in a period of bullish spirits. And so, to me, I'm both extremely excited and nervous at the same time. And it sounds like a bit of a cop out, but there's actually truth to it. Um, I think we're nervous when you see a company that's been around for 3 months raising, at $5 billion valuations. We know there are some really special people who deserve those valuations. Like I think what we've learned over the last few months is that there are, a small number of people whose minds will dictate the future of AI. And if you're invested in those people, it's a very special outcome. But we also think there'll be a lot of overvaluation alongside of that. So we're hoping that our managers stay at the lower end of valuations. So recognizing AI has a huge potential, but staying grounded in the way they approach it is the way I look at this market, to where we don't want to chase the exceptionally valuable or overvalued company. Let's see if you can stay in the right lane, but find someone there's something about that person that made them, they're not going to raise 100 million, they raise a 10 million. So I'd say it's excitement because of technological shift, but a little concern because of the valuation is my honest take.
I got it. So with this perception that you have on the market right now, where AI is like invading everything in technology. What should be a good advice for a family thinking of getting into venture capital? Is a good time to get in?
I think it's, yeah, sorry, let you finish your question.
No, go ahead.
I think, look, I think if you're not in it today, one should start coming in. I go back to would I put all my chips on the table today? No, but I think this is over the next decade, a lot of really special companies are going to be formed. And even if we come to believe that this period of time was an overvaluation, it'll sort itself out. And I think we can look at just like the internet wasn't a fad, AI is not a fad. It's going to change the lives of all of us on this call today. It's going to build some fabulously wealthy companies. I would come at this asset class the way we described it. I would come at methodically. And if you're not in the asset class today, start now, but think of it as a journey. Think of it as, hey, this is going to be a part of my family's wealth creation for the next 30 years. And come in sort of in that thoughtful way to where even if this was a little bit overvalued, there's still 26, 27, 28. That's sort of the way we coach our families is step in today, but again, treat this as a marathon.
Great. So, Sean, I'm going to try something new with you in this webinar, and it's what we call lightning round. So I'm going to give you a phrase that is a myth, and I would like to hear your response on that specific concept. Let's try to do it quickly so we can have many of them, but I think this will help us to wrap up what we have discussed during this webinar. So I'm going to start with the first one. Top quartile past performance warranties top quartile future performance.
No, never. Not especially not venture.
Why?
Why? Because unfortunately, people get older. Their shelf life shifts. Their technological advantages change. Their motivations shift. Fund sizes change. There's so many surrounding factors that shift that one needs to look at the overall picture, not the singular performance number.
I got it. Fund size is really important because once you
Yeah,
start getting top performances, the temptation of growing bigger is really,
e-
really, really, really big.
exactly.
Okay. Access is everything. If you cannot get in, if you can get in, you should.
No, I think access is necessary but not sufficient. You want to access the best managers for the next generation of returns and founders. And I think access tends to be driven by, again, the past performance. And we need to look around the corner and ask ourselves who's going to be the great performer the next 10 years. So you need both access, but also someone who's well positioned for success. That second piece is critical.
I got it. I agree. So you need a huge team to do VC well as an LP.
No, the opposite. I actually think you need to have time. I think one or two people can do it really well. I think if you have three, four, or five, you start to build fiefdoms, and you actually need to see a lot to be great. So no, I'd actually say one or two is a good number.
Okay. Bigger funds are safer.
I think that's true. But back to I think you said it well. Safer in a moderated return world. Safer,
So
maybe
why
not better.
why do VC if you want to be on a safer side, right?
That's my view. I mean, we very much believe in taking risk in venture. I mean, we're here for the returns, right?
Got it. This is just for you. Emerging managers are too risky for families.
No, no. A diversify. I think no. As long as you have enough of them. One emerging manager is risky. 5 to 10 of them feels a lot better.
And I would like to add here, Shan, it's not just a matter of diversification. Doing emerging managers really need a very specific skill, capacity, access, network.
All of it.
So it's not just if you do 20, you can be 20 times wrong.
Oh,
You have to have that specific capability.
yeah, I think you need to be in that top decile and then pick. And then you're picking within that smaller subset of like again, I think you need to know what bad looks like, remove all of bad, and then build your portfolio of good. It takes that muscle on what bad looks like though, and it takes time to build it.
So we have talked about the following three ones, but I just want to reinforce the message here. one or two managers are enough diversification?
No.
Definitely not. Okay. References are a formality.
No. I think finding off-risk references are necessary. One that's friendly to you, a personal connection or an honest one. Finding honest references is critical. That's maybe the way to put it.
Got it. Brand equal edge.
I think not necessarily. Brand is helpful to get access, but the ability to pick great companies is a separate necessary skill.
Okay. Venture is only for tech-savvy families.
Not at all. No, I think venture is a part of everyone's family that wants to generate um, broad-based alpha. But one needs help though. I think that's the necessary piece. Find assistance.
This one is a good one. DPI alone proves a manager's quality.
Mm, I think no. I think a lot of managers force early DPI, and again, we're playing venture for upside. And if someone captures a tiger and takes all their chips off early so they can raise their next fund, if you sold SpaceX, 10 years ago, like it would have been a great return, and then you would have missed like the massive return over the next 8 years. So I think DPI, I don't call someone a winner till they generate DPI, but DP alone is not enough. DPI alone is not enough. A 2x DPI fund is fine, but we're looking to play for 3x, 5x, 10x, etc.
Sean, I want to ask you a question that I left in the previous part of this conversation, and is okay. You are in a SpaceX, and you have been there for 20 years. What are the options for you to get liquidity? Just to tell the people that you don't have to wait all the way until it's
No.
public or whatever. There are other ways to get money out, and I'm building on that. When you get and when to get out, you can get
E-
out really early and miss the big opportunity. But how you assess that?
Absolutely. So I think in the world you're in one of these special, we call them Halo companies. Stripe and SpaceX are the two best examples. The good news is a Halo company inherently has liquidity options. So there have been lots of regular liquidity for both. SpaceX has had the ability to sell at multiple points. The funds themselves would send us a document. Hey, would you like to sell your shares? Would you rather roll them? Um, to us, what we've done is we were fortunate to have two different managers with SpaceX, and we elected to exit out of one of the managers' positions. That way, we created that took basically 30% of our chips off the table. So it wasn't just our cost basis back. We took off like full funds back worth of SpaceX to sort of get the DPI, so to speak, across the full fund layer. And then we allowed some of it to keep running. And I think that's a nice way as a family to invest. You can't just leave your chips in a company forever, right? At some point, it needs to turn into cash. The good thing is the markets are getting less. While companies are staying private longer, there's also new liquidity options being formed along the way. My personal view is the public markets and private markets are sort of having this like slight convergence, like a middle gray area where there's quasi liquidity available for the very special companies. So yes, there will be liquidity over time in the special companies.
Thank you, Sean. Here are the last two. If you can't get to top brands names, you shouldn't do venture capital.
No, I don't think that's true today. I think the top brands, some of them will still do well. I think if you took the top 10 brands as an index, I don't think I'd want to own it. I would not own it. We would not own the top 10 as an index. I don't think that'd be a great venture return. I think a few of them are still really, really good. I think there are plenty of groups. Like I always joke with our clients, they know two of our managers because two of them are multi-stage. They should not know the other names until we send them a ton of money back because they're all unknown, right? And then eventually they'll hopefully send a ton of money back, and then they'll be known. And by the way, we'll be scaling out at that point in time because they'll be much bigger. We'll be going down. It's just the nature of things.
That happened to us as well. And the final is fund of funds always underperform due to double fees.
No, I mean, again, I have had the luxury of seeing, I don't want to name the examples, but there are a few that have just done 3x, 4x net over time, like really exceptional performance. So I think Venture, because there's so much alpha available. Again, that divide between good and bad is so obvious and different. If someone picks really well, they can offset the double layer of fees multiple times over and easily justify their existence. That's the reason there's been a handful of very successful fund to funds over long periods of time in venture.
Sean, last question is something that is happening here in the chat. People are asking, do you work with families outside the United States? And what is the process to have access and explore the opportunity to work with Grecian partners?
The way to work with Gresham, we could work with families outside. We work with U.S. dollars. So we have one family, for example, in Australia who invests with us on a U.S. dollar basis. So it's more about having access to U.S. dollars to invest, and then reach out to me would be the easiest way. We have a website, greshampartners.com. It'll share lots of high level information on how we think. More than welcome to reach out to me individually. I would get someone in touch with the right person, but it's really case by case basis. We're looking for partners. Like the one thing back to that invest in venture every single year, which I firmly believe, we want people that'll be with Gresham for a long period of time because we believe that's the best way to generate wealth on both sides of the equation. It's a good partner for us. We can think thoughtfully and long term, and we can help them build generational wealth over long periods of time too.
And it has been a great conversation, a lot of value out of your experience and your view on the asset class. And I think it has been very valuable for the audience. So thank you much, Sean. Thank you for being with us and share all your experience.
Absolutely. It's been a lot of fun. Take care. And anyone on the call, please don't hesitate reaching out.
Thank you very much, Sean. Bye-bye.
Yeah.
Have a great day.